Hello, and welcome to the SAS Financial Advisors webinar, The When and How of Retirement Account Contributions. This webinar came about because tax day is nearly upon us. It's now April, and for the tax year 2020, tax day has been extended to May 17th, but typically tax day is around April 15th each year. When, how, what, where, and why of retirement account contributions. On the left-hand side, the green pail, typically when we think about our retirement contributions, we are thinking about our workplace retirement contributions if we're lucky enough to have one provided for us. Now with tax day approaching, now April for the previous tax year, the deadline for 2020 in this case to contribute to a workplace plan was December 31st. So that's already passed. The end of the year, December 31st is the deadline for defined contribution plan contributions. Defined contribution plans are offered through your employer typically. They include 401k, 403b, 457. And our typical recommendation from SAS here is to contribute especially and up to the company match. So if they offer something like 100% of the first 4% or 50% of the first 6% or various other matches with that terminology, contribute up to those percentages to make sure you're taking advantage of the full match. Essentially, people call it free money. And the reason why we're bringing this up in a conversation about tax day for the when and how of retirement account contributions is because now that you've filed for 2020, you might have some insight into what 2021 might look like. And being April, there's still plenty of time to contact your benefits admin to contribute to your retirement plan at work. Let's say you want to begin your contributions, or you want to go from a certain level of contributions to maxing out those contributions or making any changes. You have from April till December 31st for those payroll salary deferrals, which is the only way to contribute to these accounts, to make those changes now. Now on the right-hand side, we have the red bucket. And this is largely where we'd like to spend our time for today, though we may have a few more items about workplace plans. So for 2020 IRA and Roth IRA contributions, the deadline is actually tax day in April. And how do you make those contributions? Rather than through payroll at your work, you make those contributions through any linked checking or savings account. And where the priority is for a Roth IRA usually, if eligible, and there are income limits. Let's see, move this here. And why? If you end up having any more after you've contributed to the max of your 401k and you've maxed out, if you're available and eligible to do so, your Roth IRA or your IRA, then go ahead and top up your workplace plan up to the IRS limit. Priority. This is a pretty good flow chart for thinking about and referencing on how you want to contribute to your retirement accounts for most people. There are going to be exceptions. And in that case, contact your advisor at SAS Advisors. You can also book a meeting at sasadvisors.com. And we're all available, the whole team, through emailing info@sasadvisors.com. We're happy to help. But for the vast majority of people, especially with a workplace plan, you want to look at where to invest. And if you have a 401k, yes or no, and so on and so forth down the flow chart, which does prioritize a Roth IRA if you're eligible, and also maxing out the workplace plan after the Roth IRA. Employer-sponsored plans. Special tax terminology is that they're called defined contribution plans. Again, the end of the tax year, December 31st, is the deadline to contribute. It's funded from your selected employee salary deferrals through your payroll administrator. The deadline is usually the end of the tax year, and total salary deferral allowed currently, we're now April 2021, is $19,500 per year. If you're age 50 and up, there's another $6,500 catch up, so $26,000 is the total. And it's good to note here, some plans will allow for additional above these limits after tax 401k contributions. But go ahead and speak to your SAS advisor, and we'll advise you on how to ask these questions to your benefits admin or HR. So the main action items here is aim for your highest contribution to capture your employer match. And then beyond the match, contribute as much as comfortable for your cash needs. And, in general, the younger you are in your career, targeting about 10 to 15% of your earnings or your wage or your gross salary to be deferred into your retirement plan is a good objective every year of your career until you retire. The higher that percentage, the higher certainty of success you'll have in funding your retirement at a particular lifestyle level that you're used to and comfortable with. The lower you are is just fine as well. There are phases in life, for instance, young families who just purchased a home with young children, or maybe there's job loss. There are reasons why you would dial that down out of necessity or a different phase of life. But the recommendation in general for most is 10 to 15%. And some employers offer Roth versus traditional 401ks or 403bs, and also 457. Roth contributions are taxed now. And then when you distribute those funds in retirement after age 59 and a half, they will be tax-free when you distribute them. Whereas the traditional 401k, you get the tax deduction now. And when you distribute in retirement, those will be taxable. IRAs, individual retirement plans. As we stated before, the deadline is the tax filing date. And per the ARP Act of 2021, additional pandemic relief for America, that was passed earlier this year, it has been extended and it's unusually May 17th. Normally it's in April. IRAs and individual retirement accounts have different contribution eligibility criteria. And the criteria depends on if you file your taxes as a single individual or a married filing joint individual. And there are also income phase outs for traditional versus Roth IRA contributions, and whether you participate in an employer-sponsored plan. So another reason why bringing the 401k or 403b and other defined contribution employer plans into this conversation is it is one of the eligibility limitations. Maybe your household has a spouse who is not currently earning an income, whether by choice or not. And in that case, the household may also be eligible to take funds from the household to fund a spousal IRA. Now, there are special circumstances there, so meet with your advisor. Again, info@sasadvisors.com or book a meeting at sasadvisors.com. And for IRA contributions, there are maximum limits, which are set at $6,000 annually, and an additional $1,000 for age 50 and up, so $7,000 total. After-tax contributions or non-tax deductible contributions into a traditional IRA are allowed. Now, the math can get murky and fuzzy if you have a blend in one single IRA account between pre-tax contributions and after-tax contributions. So, typically the point there is to save more for retirement because you can, but you maybe pass certain income limitations. And maybe there's an interest in a potential Roth conversion of the after-tax IRA funds. I would definitely speak to your advisor if you're interested in this strategy, and we can walk you through the simplest way to set you up so that if you'd like to consider this strategy at some point in the future, you can. There's a rule of proportionality. So if you have a blend of pre-tax IRA funds and after-tax IRA funds, if you convert some of those funds the IRS will treat those funds as combined, even if you feel as though you're only converting the after-tax IRA funds. So some action items. We're going to have some links to determine if you're eligible to contribute to a traditional IRA for 2020 in the subsequent slides. And we're also going to have some links to see if you're eligible to contribute to a Roth IRA. Most tax filing software, TurboTax for instance, or a tax preparer like a CPA, can, should, and will notify you of eligibility and the amount. But it's best to ask, and it's also essential to know what that amount is before you file, because you may be given a maximum amount that is helpful to complete your tax filing, but you maybe aren't able to contribute that amount by April. So let's say your tax preparer says, you know, so-and-so, you can contribute $7,000 into your rollover IRA this year. And you say, that's great. I'm actually only available in my cash flow and savings right now to contribute $2,000. Because it's a pre-tax contribution, your accountant's going to want to know the final amount in that case before the filing completes. It'll be important to know which you will choose or which combination. There are combinations and phase outs. It gets a little complicated in one particular income phase out amounts, so contact your advisor if you have questions there. And if you're interested in an after-tax IRA, ask your advisor. Earlier, we talked about after-tax 401ks. They are different. They have plenty of differences. So if you have questions on either, both, again, ask your advisor. So on this slide, we include 2020 IRA contribution and deduction limits and the effect of modified AGI on deductible contributions if you are covered by a work retirement plan. We have the link for the 2020 amounts and also 2021. And you'll want to be able to identify your household filing status, your modified AGI, which for most people will be your AGI, but talk to your tax preparer and or your advisor if you have questions there. And then follow the instructions on how much of an IRA deduction you can take. "2020 IRA contribution and deduction limits effect of modified AGI on deductible contributions if you are not covered by a work retirement plan." We have, again, the links to 2020 and 2021, and we're including the 2020 snapshot here. It's important to point out, for single individuals, this is perhaps a little bit easier to determine. For married filing joint households, it's not enough that just you are not covered by a workplace plan, but you also have to take your spouse who's filing with you into consideration if they are contributing to a workplace plan. So the limits are a little bit higher if you are not participating and your spouse is, but if you both are participating, the limits are a little bit lower. The amount of Roth IRA contributions that you can make for 2020. Again, for most people, prioritizing the Roth IRA after you've contributed to your workplace plan, if they offer a match, taking full advantage of that match, then taking full advantage of any Roth IRA contributions that you're eligible to make, then revisiting your workplace pre-tax 401k plan. It's typically a winning strategy for most employed individuals. Again, there can be outside cases, and if you have questions, contact your advisor just to confirm. It's always good to have a draft of your tax filing at this point in the year. It can be extremely helpful if you haven't yet filed your taxes, but you have a draft that you've created with all of your relevant tax filing documents, W-2s, K-1s, so on and so forth. I wanted to point out here, if you take a look at either married filing jointly, there's if your modified AGI is above or equal to 196,000, but less than 206,000. And there's a similar phase out. It's called a phase out range if you're single. You may be able to contribute some, but not all. of the eligible amount. So instead of the full 6 or 7,000, maybe it's $2,350. And there are calculators that can help you compute this, but SAS has done that on a regular basis for their clients as well. If you're self-employed, if you have earned any income with a document called 1099 NEC, which has replaced non-employee compensation, which previously may have been on a 1099 MIS, MISC for miscellaneous. That's now all on 1099 NEC. Or if you're a business owner, and especially if you're a business owner and single employee of that business with no plans to hire additional employees. You have more flexibility in terms of the deadline. So we talked about the stringency of the December 31st deadline for workplace plans. For the self-employed or business owner and single employee, there can be more flexibility beyond December 31st compared to just being an employee or a W-2 employee. Also, in these cases, you may have a higher total contribution amount eligible. We talked about 401ks having a $19,500 contribution limit, and that's set by the IRS. However, when you're self-employed, there's actually an even higher limit based on other factors and calculations. Also, when you're self-employed, you may have more flexibility and options with respect to contributing to a pre-tax solo 401k and or a Roth solo 401k. So you can have both within a single plan of your solo 401k. Other commonly used small business retirement plans, the SEP IRA or Simple IRA, both are used because they are simpler than other plans in terms of their requirements, easier to set up, easier to determine contributions, easier to understand eligibility and limitations, and your tax preparer can still inform those amounts quite easily. But there can also be, depending on how many different entities or different businesses pay you income within the year, there can be different contribution styles and a solo 401k and a SEP IRA, for instance, in some cases. But we want to highlight this slide in saying, if you have any questions about any of this information, and especially if you have any of these cases of self-employment or you're a business owner and single employee, to contact your advisor, set up a meeting so that you can go more in depth on any of these items. Real easy ways to contact your advisor team. We've mentioned the email, info@sasadvisors.com. There's a book a meeting button on most pages of our website, sasadvisors.com. But we have a Calendly link directly linked to all of our calendars. So go ahead and book a meeting there. Typically, end of year and tax day are particularly heavy times of year for us. So if you don't see a time, then definitely email us if it's urgent. Some questions to ask yourself for your existing IRA account at TD Ameritrade, held by TD Ameritrade, managed by SAS Financial Advisors. Do you have your banking instructions on file? So the checking account or savings account that you want to fund your IRA or Roth IRA, do you know if those are connected? Have you made previous transfers? That's one important task to confirm with your advisor. Or if you've changed your account, your funding account, we can make those changes in time as well. Would you like to better understand if you're eligible to open an account, spousal IRA or spousal Roth IRA for your households? If so, definitely contact your advisor as well. And in all cases, please indicate in your communication with your SAS financial advisors as well before May 17th as possible, the amount you would like to contribute, whether it's an IRA pre-tax contribution or a Roth IRA contribution. Again, the amount and also the date that you'd like that transfer initiated. We appreciate everyone taking the time to attend this webinar. Our goal at SAS Financial Advisors is to constantly deliver exceptional client service to all of our clients, both who have assets under management with us for investment management and also financial planning, which we do standalone as our fee only practice as well. Thanks again, and we look forward to offering you more chances to learn about financial education and financial planning along with investment management through the SAS webinars. So keep an eye out for future surveys on which topics interest you most, and never hesitate to contact your advisor to discuss topics that you'd like to see us dive further into. Thank you so much and have a great day. We look forward to working and hearing from you. We'll take questions now.